welcome to this week's episode of Coinscrum Markets. I'm Teana Baker-Taylor. Coming up, BlockFi's David Olsson joins me to review the crypto lending markets in this week's crypto RFQ. Nisa speaks with Anthony Scaramuci about where Bitcoin is sitting on his radar and what Fed policy means for the asset class. Brian Foster and Ben Floyd from Coinbase's institutional team are here to discuss their recent report and their acquisition of Tagomi. And ByteTree's Charlie Morris is here for a macro view on the markets and this week's on-chain reaction. First, a look at this week's blockchain industry news. Leading crypto derivatives exchange FTX has had a busy week. After announcing the launch of a new perpetual swap contract designed to track the value of assets locked in the top 100 liquidity pools on Uniswap, the Hong Kong-based firm further announced another acquisition. They've acquired the mobile-first portfolio management app Blockfolio for $150 million. And a move they say will ultimately deliver a new trading experience for the app's 6 million users. In other M&A news, Consensus announced that they are acquiring Quorum, JP Morgan's enterprise blockchain platform, in a deal that will also see the investment bank take a strategic stake investment in Consensus. As a sign that Ethereum-based DeFi projects are becoming perhaps a victim of their own success, leading digital asset custodian BitGo, operator of the wrapped BTC token, has started reaching out to community partners to develop a sidechain version of the popular asset in an attempt to reduce the cost of Ethereum transaction fees, which topped more than $6 for a brief period earlier this month. The demand for transferring crypto-based assets continues to grow in other areas too. Tether, the dominant dollar-backed token, widely used by traders, surpassed both Bitcoin and PayPal in average daily transaction values this week, no doubt strengthening the case for central bank digital currencies that were covered extensively in a report published by the Block last week. All of this activity continues to attract the attention of governments across the globe. The Russian financial authorities announced this week that it intends to invest $1.2 billion in an AI-based surveillance system to track the transfer of digital assets. And in the US, the IRS has rebooted its efforts to encourage US citizens they suspect to be actively holding, using, or trading crypto to file their tax returns. Don't mess with the tax man. That's the news for this week. Don't forget to click and subscribe to our channel for more updates. Next up, Crypto RFQ. I'm delighted to be joined today on Crypto RFQ by David Olsson, Managing Director of Europe and Asia at BlockFi. Hey, David.
Hi, Teana. How are you?
I'm great. Thanks for joining us today.
Thank you.
We're going to talk a little bit about the futures impact on the lending market today. So, David, tell us a little bit about why lenders are looking at the futures markets.
Sure. So it's about opportunity costs. So lenders have a choice between putting their funds to work with their clients who might be borrowing USD against Bitcoin collateral or other types of collateral so they can leverage their positions. Then you have obviously the futures market where the futures may trade at a premium to spot, and entering into a cash and carry trade, which has been in the press a lot, is a way for investors to realize a fixed yield if they hold the future to expiration.
So, David, what's the futures premium? Some fundamental investors might not completely understand the mechanics. So could you explain this a little bit more?
Sure. So a future is a contract where an investor agrees to buy or sell an asset at an agreed point in time in the future. The basis is the difference between the future price and the spot price. And the basis is said to trade at a premium when the basis is positive, when futures are trading above spot, or at a discount when the futures are trading negative to the spot price.
Okay, so what drives the futures into a premium or discount position?
So it's about supply and demand and the structural features of the market. So onshore in the US, you have certain investors that cannot touch Bitcoin or physical Bitcoin for one reason or another.
Mm-hmm.
They have to gain exposure to Bitcoin either through a fund or through futures on a regulated exchange like CME or backed.
Right.
So in that case, demand outstrips supply. As you have these institutional investors who come on primarily to go long. Then you have overseas speculators who are predominantly retail investors who look to futures exchanges to predominantly get long exposure as well to Bitcoin. And market makers may not be as willing to provide inventory, thus there's upward pressure on the price of the futures above spot. And those retail investors are looking obviously to get leverage as they bet on the performance of Bitcoin.
Okay, so how does this impact the lending markets? Why are lenders interested about this? Why do they care?
Sure. So the primary, again, it comes back to the cash and carry, a bit of the cash and carry trade. And optionality that lenders might have in lending to their clients in the borrowing and lending market, the secured borrowing and lending market, or trading the futures curve and realizing carry if they hold futures to expiration. So if you look at what happens when the premium spikes, and if you can see that recently, for example, on August 18th, some very interesting price action. You saw Bitcoin move through 12,000.
Right.
And you can see from the chart that the price or the premium on the CME moved to almost 20%. Then a couple of days later, as the price of Bitcoin came back down below 12,000, you see the premium contract to about 8%. Mm-hmm. So that demand and that fundamental kind of supply demand aspect that I spoke about before has this impact on the premium. Lenders can then say, okay, I can sell futures short. I can realize that premium by holding them to expiration, buy Bitcoin spot so that I'm market neutral, so I have no market risk, and realize that yield. If that's greater than where they can earn a yield by lending to their clients, that might be a more attractive opportunity, and thus supply comes out of the borrowing and lending market, moves on to the futures exchanges, and the traders who are looking to borrow then have less supply, and the price of borrowing moves, those funds moves up. Conversely, the pendulum can swing back the other way, where as lenders short futures, the premium comes in and then collapses to a point where actually it's more attractive again to deploy funds into the borrowing and lending market. So that's the dynamic that lenders face, and things can swing about pretty quickly, as you can see. From this chart, if you look back from March to August, there's this tracking the CME premium and discount. You can see March 12th and 13th, the premium collapsed, or the basis collapsed, went from premium to discount, severely negative. And then as Bitcoin marched higher up until recently, the futures just steadily increased their premium.
Okay. So, last question, what happens when, Bitcoin decides to stable off again and not do anything for another couple of months like it did at the beginning of the year? How does this impact what's happening in the futures and lending market?
Yeah, I think so. Then you might see volatility. You will see volatility come down. You might see premium sort of slowly dissipate as speculators overseas get less excited, use less leverage, and even long-only investors in the U.S. May look to deploy into other assets like equities. But as you know very well, Teana, that anything can happen at any time in our market. So
Very true.
I'll leave it there.
Brilliant. Thanks so much for joining us today. It's a pleasure to have you.
Thank you for having me.
Having earned his stripes early in his career at Goldman Sachs, establishing Skybridge Capital in 2005, and a notoriously short spell as the White House Communications Director in 2017, few cover the financial and political spectrum better than Anthony Scaramucci. With the current economic environment pushing digital assets further onto his radar, Anthony joined Nisa this week to share his thoughts on the future of blockchain and Bitcoin as a viable asset class.
I'm delighted to be joined today by Anthony Scaramucci, founder of Skybridge and noted political figure. Thank you so much for being with us today, Anthony.
Noted political figure. You could have said infamous, notorious. That was very nice of you. Thank you. Good to be here, Nisa.
Absolutely. So
you beat me on Room Raider. You've already beaten me on Room Raider. Good job.
I know that you've recently bought some more gold and have long been looking at the digital asset space. What is your view right now? Are you buying any Bitcoin or other digital assets?
Well, at the fund level, we have yet to buy digital assets, but what our firm has been doing since I returned to Skybridge in 2018, we've done a deep dive into the digital asset space. I am a fan. I believe that digital assets have a future. Obviously, the blockchain has a future. And digital assets, because of the way our generations work, the millennials are enraptured by digital assets. And I don't know what the demographic is below the millennials. Maybe it's Generation X. Maybe that's what it's called. That bubble of demography is going to push digital assets up, in my opinion, into the stratosphere. I also believe that if you are able to develop a confidential chain of transfer of wealth through the blockchain, as an example, it will be once again transformative for the country. And so weirdly, as prominent as something like Amazon is right now, just imagine if you took all of those intermediaries out of the chain, meaning right now, we go to Amazon to buy goods from different suppliers, but if you had a interlocked, secure blockchain and you could transfer money electronically, you might be able to cut out even more middle people. You may be able to save the consumer even more money. And so 25 or 50 years from now, the companies that we think are here and are here forever may not be. You know, I'm old enough, you're certainly not, but I'm old enough to remember AOL, and everybody thought, well, that's how we're going to get our internet for the next 100 years. And that didn't happen. And believe it or not, there was a company prior to that was developed inside a Sears Roebuck, which was called Prodigy. So the blockchain is going to provide this amazing future. It'll be a digital asset future, frankly. If you want to talk about fiat currency and the destruction of value through fiat currency, I'm happy to talk about that as well. I think that's going to be another pressing issue. I don't think we're there yet, and I think that stuff, frankly, is exaggerated from a macroeconomic perspective because the United States still has a reserve currency. The United States still has a tremendous amount of balance sheet flexibility. And again, if we're just talking about demography, people over the age of 50, which I happen to be, that group of people, 50 until the RIP zone, right? You're 50 and then you're heading for rest in peace. That group of demography, they are still old-fashioned. They are still tied to the US dollar, the euro, the yen, and fiat currency. And so that will exist longer than the digital currency mavens want it to, or even potentially believe. But that doesn't mean that there won't be a great future for digital assets.
And there could be some combination thereof, like China's digital yuan, the US digital dollar alongside with crypto, alongside fiat. There could be a basket.
I agree with that. I think that the digital yuan is a transformative moment. The U.S. is reluctant to do that. We both know the obvious reasons why the U.S. doesn't want to do that. They want to be able to control the picture. They've been using the U.S. dollar as a foil against our political adversaries, whether we're sanctioning North Korea or sanctioning places like Iran or freezing dollar assets around the world for our adversaries. You can't do that in the digital marketplace, as we both know. And so I think that's where the general reluctancy is from the United States. And I think that's the reason why the U.S. Treasury came so hard at Libra. I don't know where Libra is going. You probably know better than me, but it seemed like Libra fizzled out. It didn't seem like Facebook was up for the fight to put Libra into the commercial marketplace.
Well, it's still going, but we'll see what happens there. It might have been the sacrificial lamb for Facebook, but
for now, it feels that way to me for now, because they have so many other problems as it relates to the information on Facebook, the false information on Facebook, the portrayal of different things going on Facebook, the capturing of data. They're under the scrutiny of the Congress to such an extent that it may be beneficial to them not to pursue Libra right at this moment. That doesn't mean something like Ethereum or something like Bitcoin is not here to stay and won't have a long-term commercial viability. I believe that they will. And listen, I mean, if you're going to run $3, $4, $5 trillion of deficit spending in a year, and the U.S. economy is a $22, $23 trillion economy, and you're going to have 25 to 30% in deficit spending from your government, you just have to think about the magnitude of that, right? They're taking in $3 trillion in tax revenues, but you're going to have an $8 trillion budget, and 5 of it's going to be in deficit spending. That's going to eventually have an impact. People can pretend that it isn't. I am not a modern monetary theorist. If you like that stuff, you should read Stephanie Kilton's book called The Deficit Myth. It's a very, very good book. It explains a lot of reasons why we have laxity and latitude on deficit spending, but she does point out correctly in the book that deficits do matter and they cannot go on forever. The apple cart will get upset and people will lose faith in that currency. And so, as you lose faith in a currency, living standards change. So there are so many reasons why digital assets will have a future. And some of it is born from the way we operate our governments. And remember, our governments are about give out as much as you possibly can and overpromise as much as you possibly can so that you can stay in power. Democracies are set up to have this sort of long-term disorganization.
Right. And just since the pandemic, we've seen this wave of institutional validation of this asset class with George Ball, who is the former Prudential Securities CEO, Jamie Dimon turning around, Goldman advising their clients to avoid Bitcoin in June, but then now building out its digital asset team, Paul Tudor Jones, MicroStrategy's treasury investment of $250 million just last week.
Yes.
So, are we at that point where BlackRock is an investor in MicroStrategy? Are we at the point where you expect to see more digital adoption from institutions?
I think so. Yes, I think so. I don't think it's going away. And again, I have 5 children, 3 of which are millennials, and they are ready to transact and buy their Tesla in Bitcoin. They're not fearful of it the way the older guard is. And so, yes, and that's typically what happens. You think something's not going to change until that younger person gets a little older and they're already used to doing things the way they're doing them, and therefore the change happens. So. I have friends of mine that are in their 80s and they have their assistants read to them their emails. And then they respond to the emails through dictation and the assistant is typing out the email. They're in their 80s. They never read an email when they were in their 40s or 50s. And so they're not going to do it now in their 80s. But you've got people that are my children's age in their mid-20s where they have a USB that has some digital currencies on it. And they have an idea about where they think these digital currencies are going to be. And you tell me, I mean, if you have a fixed supply of Bitcoins, and so therefore, definitionally, there's a stability to that currency that cannot be corrupted by a central bank or a government, that all of a sudden becomes intrinsically a store of value. Now, if you say to somebody, well, all it is a computer code or it's a sequencing of code, and so therefore, why should that have value? And you say, okay, well, why should the piece of paper in my pocket have value? Okay, it has value because there's a perception that it has value, and it has value, and it's a store of value, either in the Bitcoin's case or gold's case, scarcity issues, the definitions that the population will put on it. And so we're getting there now where there's a very large group of the population that is willing to define value in things like an Ethereum or Bitcoin. And so anyway, the same way that they would a dollar or a piece of paper in somebody's pocket. And so listen, you know it, I know it. The question is, how do you invest in it? I have been slower moving on it because I've got my own complications and my own business. Will Skybridge someday have a digital asset fund or be affiliated with a digital asset fund? I think that's a distinct possibility. I'm waiting because I'm tied to a lot of these old firms. You know, my marketing platform is tied to places like Merrill Lynch and Morgan Stanley and UBS. And so I don't want them to think I'm losing the investment discipline that I have in my core business by reaching into that area yet. But as it starts to mainstream, we'll definitely be more involved.
Great. So given that we're in the middle of an election in the U.S.
Are we? I didn't realize that. We are? Well, who's running?
The Trump administration has come out against Bitcoin. Do you think there's any candidates that would be pro digital currencies? And do you think that implementing blockchain in voter fraud is a possibility?
Well, certainly not with the president, right? Because he's taking mailboxes away and he's trying to figure out a way if he can, put the odds of electoral success in his favor. So he's not going to want to eliminate that sort of level of manipulation. I think you also find in our democracy, the brutal truth of our democracy is that the people that are in power, the political establishment, like the fact that there's scant voter participation. So imagine if I told you I could vote from this computer terminal that I'm talking to you from. My fingerprint identifies me as the voter. The blockchain transfers that information to the Board of Elections. So now we know that my vote is actually my vote, and it was done over the blockchain. So we know that the transfer of the information was quite secure, and therefore there would be no fraud. And we were able to get our voter participation up from 49% to 89%. Well, your politicians would not like that, because that would cause a disruption of their power base, and that would cause a recirculation of the elite. Lots and lots of Americans are unsatisfied with the political establishment, but they don't vote. There's voter apathy. But if you made it so convenient that they could vote from this computer screen over the blockchain, and let's say you opened up the voting on September 1st and said, okay, the presidential election, the final vote tally will be November 3rd, and go to your computer and log in and tell us who you want to have be the American president. These people would flip out over something like that. They wouldn't want that.
So what you're saying is...
Any more than they would want a third party, Nisa. They don't want that either.
Right. So based on last night's DNC, what you're saying is the Democratic Party would be more in supporting digital assets.
Well, I don't know. I think what happens is if you get the top job and you're sitting there with the Federal Reserve Chairman and the Treasury Secretary, and they're saying, well, if we move in the direction of digital assets, the dollar is going to lose its sanctioning strength. I'm not just talking about the dollar as a store of value or the dollar as the global reserve currency. the United States has used the dollar as a political weapon against its adversaries. So if you're Vice President Biden, now president, and you're sitting in a intelligence briefing and you're in the, you're in the Oval Office talking about this, or you're in the Situation Room downstairs from the Oval talking about it, and they tell you, okay, yeah, that is the future, but right now we have all of this political power by knocking down Bitcoin, knocking down Libra, and allowing for continued dollar superiority on the globe. They'll probably be inclined not to want it. You mentioned, are there political, somebody like an Andrew Yang, I don't know if you remember him, he was running for president, very thoughtful, genius tech entrepreneur. He's embraced the digital assets. The fact that China is embracing the digital assets means that we're going to have to at some point. The question is when. In my opinion, our political leadership will wait as long as humanly possible.
Right, and we have the digital yuan being implemented, and in the U.S. we have the digital dollar committee. To your point.
Correct.
So back to your point.
Born from the reality of the politics, I might add.
Yes. Back to your point about generational differences. You've said previously most inflation-proofing hard assets have mostly been the preserve of the middle classes. And Coinbase reported a 4 times wave of increase of $1,200 deposits as soon as the stimulus checks went out. Have we, has the Fed simply setting the scene to naturally push this disenfranchised generation that's been left economically detached, to just invest in digital assets?
Good. It's a good question. And so a portion of that demography, yes, is the answer. All of that demography, no, but a portion of that demography, yes. And unfortunately, if we look back on this era, 100 years from now, there will be a historian that writes, man, that baby boomer generation really screwed things up. They were transferred power from the greatest generation that fought the Second World War and helped build the post-World War II architecture. But boy, those are really a selfish, narcissistic group of people that took power and they sort of wrecked the system. They ran up $20 trillion of deficits. They weren't careful in terms of managing the fiscal budget. They overpromised people. They underdelivered. They allowed the infrastructure to crumble. They allowed the educational system, particularly the public K through 12 educational system, to become uneven. And all of this caused them to lose confidence in their currency, a result of which a large portion of that population, after the baby boomers, went into the digital side because they weren't worried about the manipulation of the government on the digital side. And so, listen, I mean, we have to take a pause, in my opinion, and we have to try to reconstruct our political leadership. And we have to get it back onto things that are based on right or wrong as opposed to left or right. And so are we going to do that? I don't know. If you study Gibbons and the decline and fall of the Roman Empire, they couldn't do it. They got to a period of time where they went into steady decline. Now, if you look at the United States, it's only 244 years old, but everything you and I both know is accelerating because of what's going on in the world in terms of technology. So something in the ancient world that could last 1,000 years, 500 years, maybe can't last as long in the modern world. But what I would like to do is cheat that history. I would like to figure out a way if we can hack the political system and get back to something that's more balanced and get back to something that's more practical. And also, I think if you talk to people directly, instead of through all this political speak, you may reach them. They may say, well, wait a minute, that sounds like it makes sense. We need a 25-year plan. You're mentioning China. Part of China's 25 and 50-year plan is digital assets and a digital yuan. They see the digital yuan as circumventing the dollar if it's handled properly. And so why shouldn't we get ahead of that? Why are we waiting? And so my point is we've got to take a step back on this stuff, and we've got to sort of stop the current political madness of what we're all living in.
Where are we on inflationary versus deflationary, and how do you think that will affect Bitcoin?
Well, I think we are still in a deflationary situation, even though we're manufacturing all this money, all this great deficit spending. If you look at lost economic output as a result of the crisis, you probably have $15 to $20 trillion of lost global economic output. So you can manufacture a lot of money without it showing up in inflation data. Having said that, perception in the marketplace is 9/10 of the law. So when you see these historic numbers of deficit spending, money printing, you can see why the perception from an investment point of view is, let me run towards gold, let me run towards Bitcoin. You know, back in 2009 and 10, we made an investment in gold similar to the one that we're making right now. We weren't long-term gold bugs, but we said, okay, there's a lot of money printing going on. This will mean that gold will move up in price because people will have that perception. Remember what John Maynard Keynes said about stock market investing? He said, well, we're all judges at a beauty contest. And it's not for us to judge who is beautiful, but we have to judge who we think the fellow judges think are beautiful. And that's what makes the markets. And so right now, our fellow judges are saying that the gold prices and Bitcoin and digital assets that have more fixed value as opposed to manipulative value, they're going to go up. And so that's why we're involved right now.
Great. Well, thank you so much for your insights and for being with us today, and looking forward to continuing the conversation.
Yeah, and I hope I get a chance to see you face to face, hopefully when this ends, you know.
Absolutely.
And I appreciate you having me on.
Thanks so much.
Bye-bye now.
Since being founded in 2012 as an easy-to-use custodial Bitcoin wallet, Coinbase has grown to become one of the most dominant brands in the industry, with a full suite of services for its 35 million retail customers, and now its ever-expanding institutional client base. Having recently acquired brokerage firm Tagomi, and following the publication of their institutional review in July, Nisa was joined by Brian Foster and Ben Floyd from their institutional team to find out more about their future plans.
I'm delighted to be joined today by Brian Foster, institutional coverage, and Ben Floyd, head of OTC sales at Coinbase. Welcome to you both.
Thanks so much, Nisa.
It's good to be here.
So Brian, you recently authored Coinbase's institutional review for H1 2020, released last month. Given the size of your customer base, both retail and professional, and the range of products and services that you offer, what changes in demand, knowledge, and expectations have you seen from the institutional customers over this time?
Yeah, it's been quite an exciting period for us. I think that really the institutional landscape has just matured a lot in the past few years, and things have really come to a head this year. One of the biggest things is obviously the macroeconomic backdrop we're in right now, I think provides an interesting impetus for a lot of new participants to enter the market. So we're in this world of, abundant supply in terms of how central banks are thinking about monetary policy. And juxtaposing that is, the predictable scarcity of Bitcoin, at least on the supply side. And I think that's a narrative that folks are really excited about. So we've seen some investors who are focused on, the macro strategy come into the market for the first time this year against that backdrop. I think the other thing is just that the caliber of tools and infrastructure for participating in crypto have come a long way, largely, I hope thanks to the work that we've been doing at Coinbase. And so teams that are serious and sort of more mature have now the toolkit they need to really allocate in a way where they can defend what they're doing to their investment team and be viewed as being responsible by participating in this market. So these are two of the biggest factors. And then I do also think there's some positively reinforcing momentum here when you have larger allocators, more serious funds who are in the space new entrants that are on the fence can point to those peers and say, okay, XYZ firm is in the space. We can be too, and you're not going to get fired for making that assertion that it might make sense to allocate to crypto, whereas a few years ago you may have, at a minimum, gotten some weird glances and head scratches.
Right. And Ben, are you seeing any kind of sophistication change in the terms of trading?
Yeah, I think so. I mean, I think to Brian's point, we're getting a whole new type of customer segment coming into the space now. And I think it's had a long time. It's been a long time coming in that they've needed good custodians. They've needed to get comfortable from a regulatory perspective. But now that they're into the space, they are demanding a lot of the same tools that they would get in traditional markets. So whether that's kind of algorithms that allow them to be slightly more nuanced in how they trade. If they're looking to build a large position, they don't want to necessarily do that in one go. They might want to do that over a number of days, and they might want to be aggressive at a certain level while being slightly more passive at others. So I think that's definitely changed. And I think the conversations that we're having with these more sophisticated traditional asset managers, there might be a global macro hedge fund or a pension or an endowment, is much more typical of the conversation that we would have had in traditional finance when dealing with these types of participants. So I think it's been a huge step forward, and with some of the tools that firms like Tagomi built, who are obviously now part of Coinbase, the ability for us to actually execute in that nuanced way for them is that much better. And I think it's definitely we've had a great reception from all of those clients to date, not only from an execution side, but also from the reporting, for them to understand exactly where we're executing and why we're executing there, and having a slightly better concept of the best type of execution for them, and being able to create a strategy around building a position is something that I think a lot of them are getting a lot more comfortable with, and it's been a great few months as a result.
And then prime brokerage as well, which led to your acquisition of Tagomi, right? And why acquire rather than build in-house?
I think the short answer here is just time to market. So, as we engage more with, I think, serious institutional customers who wanted to trade in size, it became apparent to us over the last 2 years that we would need to move to a multi-venue execution world, just like you see in, the FX markets or other more mature asset classes. And then the question just is, how do you do that, most effectively? And when we met the team at Tagomi, I think we were, ubiquitously impressed. Like everyone at Coinbase said, these folks are the real deal. They have deep experience in traditional markets, and above all, an incredible product. And so bringing that team in-house and being able to integrate their technologies allows us to get to that vision of providing multi-venue execution much faster than we could have if we went at it on our own.
I think just building on Brian's points there as well, the product that they've built, we've been using it now for the past few months, is incredible. And the ability for us to provide a great service to our clients as a result of those tools is something that we just couldn't do 6 months ago. And I think crypto is still a very nascent asset class, and the market structure is still relatively immature. But for that team to be able to build a tool which routes to 10 different exchanges and a number of other pools of liquidity, and giving you like a great sense of why you dealt where you dealt and why that's a good fill, is something that institutional clients are used to in other asset classes, and they're now getting from the Tagomi tools. To Brian's point, it's not a straightforward thing to build. So to bring it in-house and bring that team in-house felt like the best thing to do, and so far it's been fantastic.
And how do you address the risks that you're now introducing when aggregating liquidity from other venues? So
I guess in terms of aggregating volume from lots of different venues, as I mentioned before, the market structure is still relatively immature. So really leaning on the expertise that Greg, KJ, Jen, and Mark and the team have from other asset classes is kind of how we mitigate some of that risk. They've all done this before in other asset classes, so understanding where you're going to have problems, where you're going to have risks is something that they already knew. So you can't 100% mitigate away all risks, and APIs are still getting built out and becoming more stable at all various different exchanges. but they definitely made some great steps to getting there. I think in addition to that, with our tool, we can actually define exactly where a client trades. So for example, if a client says they only want to trade on regulated US exchanges, that's something that we can do for them, thereby decreasing that risk again. But it's we have a few other kind of tools to reduce risk like that as well.
And you probably saw Fidelity's recent investor survey that indicated a 7% year-over-year growth in direct crypto asset exposure versus 244% in derivatives. How does that compare with your clients? And, you know, are they expanding their exposure at a similar rate or higher?
So first of all, that was a great report. Huge kudos to Fidelity for publishing that. And I think it just does great things for the space. And so I was really happy when reading that. I think with regards to volumes and derivatives growing, a lot of the traditional funds have access to CME futures via their FCM already. So the step for them to trade Bitcoin is just another ticker. So it's very, very easy for them to do that. Trading spot is a very different conversation, and it's one that requires their security team to get involved, their compliance, but a whole range of different people. So we're seeing fantastic growth in the spot side of the volumes. But the work that the CME team are doing, which is absolutely fantastic, definitely helps a lot of these more traditional funds that are trading oil futures or various other commodity futures get into Bitcoin very quickly. So it's a great thing, and it feels like a natural stepping stone to start on the CME and then try and look at other avenues to get exposure to Bitcoin.
And obviously there's trade-offs between these different products, right? So you know, the futures and options markets allow you to express your view in some ways that you can't in the spot market, but there's obviously some sort of cost and other operational advantages to dealing in spot. And so generally once folks kind of dip their toes in the water and start to, you know, understand the kind of mix of products they can play with here, they realize, okay, I should probably be in multiple products. And so I think we're in a great position today to, you know, to serve folks from the spot market, and we're certainly paying attention to these other markets as well.
And in your report, you discussed the growing importance of on-chain data. How comfortable are regulated firms now becoming with this, and are they starting to use it for making their trading decisions?
Yeah, so I think the data space in crypto is fascinating. Just the surface area for what funds can use here compared to the traditional markets is a bit broader in that you have, you know, both your sort of financial market data, you know, what's happening to asset prices, but then also your on-chain data, which is a super interesting kind of open source map of fund flows in the space, at least those that are happening on-chain. And so we do see, you know, investors and other types of market participants starting to play with that on-chain data and use it in their models. I think it's still early in terms of adoption and usage of these tools. I would say that the vendors that are providing and sort of cleaning and making this type of data accessible are generally still quite young, and so they're growing up and maturing. But it's obviously a competitive advantage for funds who can figure out how to use this well. And so the interest is definitely there. I think we're just early in the cycles still, but funds that can figure out how to combine this data in interesting ways and generate real alpha, you know, are absolutely going to have an edge. And so we do see some promising experimentation happening there.
I think what's been really amazing to see is that some of the folks that worked at kind of top tier quant funds, like your kind of 2 Sigmas, etc., are kind of coming into crypto and are using this type of data to create trading strategies. And to Brian's point, it's still a very nascent part of the industry, but if they can get it right, then the potential alpha they can take out is just incredible. And it's just great to see super smart people coming in and applying some of the techniques from the traditional world to crypto and making it work.
What kind of involvement are you seeing institutions in, let's say, DeFi experimentation, staking, or stable coins? And how are you advising them on the risks?
Happy to take a crack at that one. So I think probably worth separating these out a bit, is they're kind of distinct and viewed differently by different market players. I would say that DeFi in particular, I think there's a lot of buzz around this category right now. For the institutional players, I think they're very far away from DeFi. So this is a super interesting phenomenon, and we're excited about it at Coinbase and supporting these protocols in every way that we can. There's something super powerful about being able to just connect a non-custodial wallet to a smart contract and engage with basically financial products turned into protocols. That's an amazing new primitive that I think will drive a lot of exciting growth in the market. At the same time, these things are very new. And so these smart contracts, some of them are unaudited and capturing hundreds of millions in locked value in some cases, where others are audited but just simply don't have the secure track record over time that would make an institution confident to participate. And then you have the whole kind of KYC AML issue where there's compliance questions, and do I really want to get involved with that if I'm an institution? So I think DeFi from a sort of product unlocking standpoint is incredibly compelling, but some of these risk factors today make it a little bit inaccessible still for serious institutional participants. Stable coins and staking, these are whole other cans of worms I think we could talk about for a long time. I'll say briefly that I think stable coins are super interesting. We've seen very strong growth there. USDC is something that we've invested in a bit at Coinbase, but it's really run, I think, a long way, even with very, very light, I would say, involvement from the Coinbase team in terms of kind of seeding that that community. What's encouraging to me is that when given a choice, we basically see that crypto traders and investors will use stablecoins rather than sort of exiting the crypto economy back into fiat, simply because there's obvious advantages in terms of execution and cost and speed of settlement when you're going in and out with stablecoins. And lastly, I would say for staking, just to hit on that briefly, we do see investors who are holding assets that feature staking taking advantage of that, and it's something we're excited to be enabling through Coinbase custody. The long and short of it is, if you have an asset that has staking built into it, you want to be taking advantage of that so that you capture the inflation reward and get the most out of your assets. So that's something we're going to continue to invest in at Coinbase, and empower other great partners in the ecosystem as well through partnerships.
I think to build on Brian's point there, the kind of the way, I guess, the way with the institutions is we'll have those that are kind of more crypto native, and as Brian mentioned, will be kind of staking or looking at governance and kind of getting slightly involved in DeFi, but more aware of the risks. And then you've got the very traditional folks that are the types of people that are newer to the space. They'll kind of focus purely on Bitcoin. And then some of them will start to look at Ethereum a little bit, but they are asking the questions, which is really encouraging. They do want to know what's going on, and they are intrigued. And I think Bitcoin's a fantastic kind of gateway to crypto in a way, and that they'll kind of come in, they'll follow the narrative around gold and Bitcoin being digital gold, and mainly because some of the concerns they've got around the macro that will be affecting other parts of their portfolio. But once they're in, they kind of see the world that we all know super well, that we're all super excited about. And DeFi, while slightly crazy at times, is incredible. And they kind of start to pick up on that. They start to read some articles. So it's super exciting when they start to ask the questions, and they ask the first question, but then they come back next time and they've obviously gone away and read loads, and they kind of ask a better question. So it's great. It's awesome to see. And I still feel like we're a little bit away before we get kind of the true traditional institutional money into that space, but they're looking at it and they're learning. And that's, at this point, I think that's all we can ask for.
Right. Well, great. We look forward to more exciting developments, and thanks so much for joining us today.
Thank you, Nisa.
Thanks, Nisa. Thanks so much for having us. It was great fun.
Next up, ByteTree's Charlie Morris joins me for this week's on-chain reaction. I'm delighted to be joined today by Charlie Morris from ByteTree. Hi, Charlie. Thanks for joining us.
Pleasure to be here. Thank you.
It's a pleasure to have you. So we're going to be talking a little bit today about Bitcoin and the correlations between interest rates and bond yields, for example. So Charlie, tell us a little bit about some of the research that you've been doing and what you've been noticing in the macro market overall.
Well, by trade, I'm a multi-asset fund manager, so I've been looking at cross correlations for 2 decades, as you can tell by the color of my hair. The relevance right now is it's the Jackson Hole shindig, where they all get together, all the global central bankers get together. This time, unfortunately, like us, it's not in person over a nice dinner. It's over a video call from far away.
Yeah.
But nonetheless, we're going to be talking about what's happening in the world. And in our first slide, we basically look at the combined central balance sheets. I'm sure many of you have seen this before. But I think what's interesting about it is that basically Bitcoin spent a lot of time going up and some time going down and some time consolidating. At the time it's been going down has been at the same time when global central balance sheets have also been contracting, namely 2014 and 2018. And, it's as clear as mustard.
Brilliant. Okay. So moving on, we were looking at Bitcoin responding to a falling in interest rates.
Yeah, so the second slide, we're actually looking at real interest rates. And a real interest rate is the difference between the bond yield, in this case, the 10-year, and the future expectation for inflation, known as the break-even rate. So it's not what inflation is reported over the last month. It's what the bond market thinks it's going to be over the next 10 years on average. Of course, it's wrong, but it's what it thinks it is going to be today.
Okay.
And so it's the best guide that we have. And basically gold trades off this quite heavily. So when real interest rates have been falling, gold has been going up quite aggressively, and vice versa. And so in 2013, real interest rates went up a lot when the Fed indicated they were going to start hiking rates. They didn't start for a while, but that's when they first talked about it. And that caused the price of gold to crash. Incidentally, Bitcoin actually did very well in 2013. So that was one of the times when you sort of said, well, this really isn't gold because they're behaving completely differently. One went through the roof and went through the floor in that same year. But over the last couple of years, you're starting to see the linkage increasing. And in this chart, I've actually inverted the axis. So what you're seeing is rising real interest rates, actually a falling real interest rate. So you can see the line. But when real interest rates have been falling, Bitcoin kind of ended its bear market in late 2018. When they stopped falling, we had a period of consolidation in Bitcoin. And then when they started falling, and I reiterate, that means the line rising, then Bitcoin carried on its charge. And really in the last few months, particularly post-COVID, the link has been very, very strong indeed. And so, you could argue that Bitcoin's becoming a bit more gold-like. And I've been tracking this for several years now, and I can tell you that it hasn't been very gold-like at all. But recently there's some indication that it might be happening.
Indeed. Okay. So let's move on to Bitcoin as a risk-on asset.
Sure. So in this chart, and I'm going to look at your camera again in a second once I refresh myself. So there are a couple of periods here. So in white, we've got the periods when the bond yield has been rising. And then in red and green, we've got the periods when the bond yield has been rising. Mm-hmm. Now, approximately 95% of Bitcoin's long-term heroic rally has coincided with rising bond yields. Now, you might think that's bad. Everyone says easy money is a good thing, but a rising bond yield is something you would associate with a growing economy. So basically, when the economy is doing well and is accelerating, the bond yield goes up, and when it's crashing, everyone starts buying bonds, and so the bond yield goes down. So a rising bond yield, despite being a high discount rate on assets and so on, is actually showing that the economy is doing better. And the interesting thing here is a lot of people think that Bitcoin's a risk-off asset, i.e. you should buy it as a flight to quality. And I disagree with that. I would say it's very much a risk-on asset, as are many internet stocks indeed. In fact, most of the stock market would behave in a similar way to that. And so, Bitcoin is a risky asset. It's a very good asset. It's going up a lot, which is good. But it tends to make most of its money when the economy is doing well. And that's certainly the observation from the macro. And the good news here is that obviously the long bond yield has been collapsing over the last couple of years, particularly this year. Which kind of explains why Bitcoin, it's done nicely this year, but it hasn't done nearly as well as it has in other years. Mm-hmm. And so I think if the bond yield starts recovering, which is likely to happen, particularly following what we're going to like to see over the Jackson Hole summit, is a rising bond yield, a recovering economy, and a higher Bitcoin.
Interesting. Okay, and does Bitcoin benefit from rising inflation?
Well, it does. I mean, that's the good news. And that's hardly a great surprise. I mean, there is a sort of inverse correlation to the dollar, but that's a small thing because effectively, that's just a measurement thing. I mean, the dollar doesn't move much, but if it goes down a few percent, you'd expect Bitcoin to rise by a bit more than that. But basically, when it comes to inflation, it's a very similar story to the bond yield. And the vast majority of Bitcoin's return has coincided with periods of rising inflation. And so when we look about, the last few years, 2018 in particular, we had the the central bank balance sheets easing. We've had bond yields coming down, inflation coming down. The negative real interest rates have been helpful, but actually more helpful would be, more bond yield, more inflation. That would really boost it. And so, I just come to the conclusion that the Bitcoin's inflation sensitive and it's a risk on asset. And that's a really important point for people to believe when, constructing portfolios. If you want something risk off inflationary, you want to own gold, risk off deflationary, you want to own the 30-year treasury. And that's how you build a portfolio around that. And when it comes to risk on, well, you've got lots of things to pick from, but make sure that you understand that Bitcoin is only risk off in some kind of hyperinflation environment. And I guess that's not going to happen this week.
Fantastic. Charlie, thank you so much for joining us today. It's been a pleasure.
My pleasure. Thank you very much.
You've been watching Coinscrum Markets. Thanks for joining us. See you next week.